What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked #1 on Wall Street in the 2024 All-America Institutional Investor Research Survey. This week on What's Next for Markets, I'm joined by Darius Dale, founder and CEO of 42 Macro. Darius brings a clear and structured approach to macro strategy with a focus on data, cycles, and risk management. We get into the current market regime, what's driving asset prices, and how investors should think about positioning in a volatile environment. Darius and Stephen, welcome back, Stephen. And Darius, super glad that you're able to join us this week. I've been a huge fan of yours for several years. I've been following your work on X. You and I have chatted quite a bit, yet we've never actually spoken face to face. So this is a first. I'm really excited. There's a lot of strategists, quantitative analysts, macro-focused researchers out there. And so I'm really excited to talk to you. You have definitely a really interesting data-driven process. Can you talk about how you see markets and macro? What makes you different? What makes you tick?
Yeah, I appreciate that. Thanks for having me, Mike and Steve. If you guys humor me, I'll start by giving you a little bit of background about our mission here at 42 Macro, because that will shed a little bit of light on why we do things the way we do things. So I cut my teeth at a fairly large Wall Street investment research house, doing all the same things you guys are doing, flying around from New York, that train to Boston, London, Hong Kong, all those places. We've all been in the same rooms and meeting with the same PMs and CIOs around the world. And I loved it. It's a great learning experience and learning journey. But along the way, something started to sort of not sit well with me. And this is true of Wall Street in general. It's not endemic to any firm. The level of insight and access and service and ultimately results that Wall Street delivers, that it trickles down to the retail community, is unacceptable. It's just flat out unacceptable. And I spent my career essentially making very rich people a lot richer. And I felt like I was leaving Main Street, which is where I'm from, behind. I'm someone who grew up in and out of homeless shelters, sleeping in vans, sleeping in motels, and obviously grew up in the projects. And I've seen a lot in my life, and the legacy of that experience would not allow me to continue leaving Main Street behind. And so I started 42 Macro, partners and I, 4 years ago to essentially bring Main Street along for the ride in terms of delivering what we think is some of the best macro risk management insights on global Wall Street. All of our clients receive the exact same information at the same time, which is a unique business model in our industry. Most people price retail investors out of the market. Most people don't have the time of day to answer questions for retail investors. And retail investors certainly don't get insights to the same level of risk management and portfolio construction, asset allocation advice that institutions tend to receive. And that's not okay with me. And so we built 42 Macro to say, hey, I don't care if you're the top PM at Citadel or some mom and pop investor with 50 grand in their retirement account that's looking to retire on time and comfortably. You're going to get the same quality of information and the same level of insights and detail from us. And I'm really proud of that.
That's incredibly inspirational.
Appreciate that, man. Thank you.
I respect that. We have a similar set of values. So that's awesome.
Thank you.
So I want to speak to that because you are unique in that you do cater to a wide variety of investors. And I'm curious, you started your firm in 2021, right after there was a huge influx of investors because of COVID, because trading became cheaper, social media, the markets were doing well. And I'm curious how you've navigated your process and mindset to be able to essentially equally cater to investors with very different time horizons, risk profiles, education, I guess, of investing or skill set of investing.
Absolutely. So I would say that's a great question. And it's a challenge. It's still a challenge today. And I think it will be a challenge indefinitely, but it's a challenge that I welcome. It starts with quality education. We spent a tremendous amount of time over the past 4 years plus of developing a litany of educational resources that cater to the different segments of the marketplace that try to graduate them up this curve to what we think is high-end institutional macro risk management. And so the education is ongoing. It's a lot of repetition. It's a lot of speaking to different audiences when I'm on various webcasts and various presentations and various pieces of research. But at the end of the day, we expose everyone in our client base to everything, right? And it's on them to take advantage of the education, to constantly engage with the material if they want to become better investors, if they want to have better investment results. Not everyone wants to become a better investor. Everyone wants to have better investment results, right? That's obvious. And so we certainly built our systematic case flow construction process, which we use to help retail investors stay on the right side of market risk. In our discretionary risk management overlay, aka Dr. Mo, we use that to help our institutional clients stay on the right side of the market risk. Both pools of clients can choose whichever risk management overlay they want. But at the end of the day, we want to make sure that we're guiding them to the right place, to the right materials, that ultimately that they can not only just have better investment results, but they can become better investors. So it's really just about education and constant, clear communication, which I'll tell you, it was a struggle for me at the beginning. I'm sure it was for you guys when you set out Twitter and social media. We talk a different way on Wall Street than the average investor or average retail investor, especially nowadays. I mean, the young millennial Gen Z investor community is just completely separate from how we think and how we communicate and how we manage financial market risk. And so that there's a language barrier in addition to I would say, expertise barrier. But again, it's on us to break those barriers down if we really want to fulfill our mission. And obviously our mission is incredibly important.
That's not an easy task. We cater a little more to the institutional base. Even within the industry, it changes over time and people's understanding of ever-evolving marketplace and trends. To accomplish your mission is no small feat.
Stephen, I have a great analogy for you. I'm sure you experienced this as well. We all did. I would say about 10 years ago, a little bit more than 10 years ago, we started hearing the phrase high quality compounders out of Boston, right? And it was coming from the young guys. The older guys, the value guys were like, these companies are way overvalued. And it turns out the Mag 7 were in fact high quality compounders and their valuations were non-stationary. So that's a great example of how that the language barrier and the expertise barrier and just the experience barrier can create different outcomes for different subsets of investors on Wall Street.
Along your work, definitely have a lot of overlap in how we view the world. And talk a little about your investment process. Where does it all begin for you?
Ooh, great question. Great question. So I assume anyone who's paying attention to this probably knows me from my podcast appearances or my TV appearances. And 99% of what I say outside of our paywall is about helping investors sort of predict fundamental economic risks, helping them contextualize what that full distribution of probable outcomes is, and ultimately where we think, what part of the distribution we think markets are most likely to price in over various time horizons. Behind our paywall, we're doing that, but that's not where our investment process starts. Our investment process starts and ends with KISS and Dr. Mo. Everything else I say beyond KISS and Dr. Mo to our clients or to our non-clients is just me trying to help them contextualize that full distribution of probable economic and political outcomes, policy outcomes, so that when our systematic KISS and Dr. Mo signals, again, these are completely systematic risk management overlays, when those signals transition their portfolios from pricing in left tail risk to pricing in right tail risk, as they have recently, or as they were earlier this year, from pricing in right tail risk to pricing in left tail risk, they feel confident enough about the future that they have the ability to dispassionately execute the systematic process. What we found from my own experience and from obviously studying behavioral economics and other systematic processes throughout my career is that human beings tend to override systematic systems at the worst possible times. And part of the reason why we do our research process, construct our research process like this, is to constantly remind investors that there is a full distribution of outcomes. Just because you're bearish doesn't mean there's no right tail risk. Just because you're bullish doesn't mean there's no left tail risk. And so our entire research process is incredibly systematic in and of itself. To one thing we do that I think is unique and boring, and boy, I would save a lot of time every day if I didn't do this, but we analyze every single time series, key economic statistic that comes out of every major economy in the world in rate of change format every single day. Why do we do that? Because it keeps me honest. It keeps me from leaning too far in one direction or too far in the other direction. It helps me understand exactly where we are in that distribution of probable economic and policy outcomes. And so we can actually piece that thing together for our clients. If I was only focused on going down the bearish rabbit hole for weeks on end or months on end, or going down the bullish rabbit hole for weeks on end and months on end, it's very easy as an investor to succumb to confirmation bias and anchoring bias and recency bias. And so one of the things we do is just try to create a fundamental research process that forces me to eschew those biases in a way that is more productive for our client base.
So is that something that you learned? And if so, was it due to experience where you felt something so strong that confirmation bias came in and then you learned your lesson? Or was it something you learned without an unfortunate lesson?
Oh, no, it's actually, I wish there was a good story behind it, but just early in my career, that was like the grunt work on the team. Like very early in my career, it was my job to communicate to my boss, hey, what did GDP do?
Yeah.
Hey, what did the unemployment rate do?
Yeah.
Hey,
Yeah.
because nobody wants to do, who the heck wants to do that every day? Like I have to create a chart or analyze this rate of change charts for dozens and dozens of economicists today. I think there were 58 time series that I had to analyze today. On average day, somewhere between 20 and 30. Oh my God, the day that they released March PCE and Q1 GDP, it was like 100 plus. But again, there's no secret sauce. It's just, I'm rolling up my sleeves and doing the work that other people aren't willing to do. There's no secret sauce in that. There's just elbow grease. And that elbow grease comes from now, I guess I'm not poor anymore, but certainly 20 something years of being dirt poor and having to scratch and claw and fight my way to the near top of Wall Street. And I'm going to continue to do that.
Data-driven approach is near and dear to our hearts and how we think of the world. And I also think the interesting thing you said, which is another idea that we value a lot, is what are you potentially missing? I don't want to put a number around it, but a large percentage of investing is making sure you don't do the wrong thing.
Greater than 50%.
It was a high number I was going to throw on it.
Yeah. 100%. People think that investing is something that you do. The more you do in investing, the worse your results get.
Yeah.
The market will make the money for you if you don't F it up. It's our job to control our behavior and our cognitive biases to not F it up. And so the reason we have systematic risk management overlays that guide all of our investment conclusions and investment decisions, and the reason we have the systematic research process is to give me a better probability, give me and our clients a better chance to not F it up. That's it. Yeah, I would rather not do this much work, but again, it's necessary in order to put the guardrails around me and what we're communicating to our clients.
I'd love to hear any anecdotes, experience, how you've evolved in your process, because I can imagine the last 5 years have stress tested all your conviction as it has everyone's, because there's been so many exogenous shocks and behavioral volatility and experience between a pandemic, an inflation shock, a tariff shock, 3 things that we haven't seen in our lifetimes, fortunately. And so how's that experience been so far? Obviously, it's an ongoing story, but it's good to have those tools. But has it evolved? How have they been stress tested?
Oh, very much so. I love that question. This is probably one of the most important things that happened to me in my career. And going back to something Stephen said, this, how could you be wrong? I personally pride myself when I'm in institutional client meetings on not getting that question, because it means I did my job of communicating the full distribution of probable economic outcomes. And
that's a good point.
I did not anchor on one side of distribution. Now I'm going to communicate, hey, I'm bullish now because our systems are bullish.
Yeah.
But if I only communicate the bullish, the right tail risk in the market, that's me doing a disservice to the client. So go back to your question, Mike. Q4 2022 was probably the worst period of performance in my career. I got squeezed royally. Many of our clients got squeezed royally as a function of my getting squeezed. And a number of our institutional clients wound up on the beach, which is code word for losing your seat on the buy side. And it was a really painful, stressful process. And the reason it was painful and stressful is because I hadn't completely embraced the systematic signals that we had built. I hadn't completely embraced at the time to allow our KISS and Dr. Mo signals, to allow the models that power our KISS and Dr. Mo signals to just guide our investment process. Back then, I was still a discretionary macro risk manager. Hey, I did all this research. I have these signals, and the sum of this research plus signal equals Darius Dale wants you to do this in your portfolio. And up until that point, I had quite an illustrious career on global Wall Street doing that. My team that I left, and we were never on the wrong side of a 10+% correction in the market, let alone a market crash. We had some huge calls on asset classes like gold and the Japanese yen, the Japanese stock market trade. I think I was the first person on Wall Street to wake people up to that, me and Mike Novogratz and Paul Tudor Jones, stuff like that. So we've had some incredible trades. I've been blessed to have had some incredible discretionary macro trades in my career. And so when I started 42 Macro, I'm taking that same level of, I guess, hubris, if you will. It's almost hubris. Hey, I've been really good at this for a long period of time. So let me continue trying to invest this way, which is one part fundamental, one part quantitative, and slapping that together and then putting Darius's human overlay on top of that to tell people what to do in their portfolios. And that squeeze in Q4 was so powerful, so sharp. And it was a function of me disrespecting the full distribution of probable economic outcomes. I had not considered the right tail risk associated with the global liquidity cycle back. So much so that since then, with January of 2023, I said enough is enough. I stopped making discretionary risk management. I stopped communicating to our clients discretionary trades in terms of their asset allocation and portfolio construction. Completely got behind behind our systematic signals, which obviously required a lot of humility because part of so much of the gain, the emotional gain we get from investing is,
Yeah.
my thesis is right. I told you to do this. My thesis is right. I feel good. And having to, I guess, adopt a new level of humility to say, okay, I don't need to be right. Darius doesn't need to be right. What Darius needs is to help his clients remain on the right side of market risk. And the best way for me to do that was to stand behind quantitative risk management signals that power Kiss and Dr. Mo, as opposed to staying in front of them and overriding them in ways that ultimately proved costly and hazardous to our client base back then. So great question, Michael, because again, it's our business took off after we made that pivot, not only because of the pivot, but also because of the performance that our clients have experienced in their portfolios as a function of that pivot. And I'm certainly not looking back.
Yeah. That's an awesome story.
How about you guys?
Oh, yeah. I would say we had a similar experience into the end of 22 into 23, where I was part of that recession fear group and thought I saw all the signals. And I would say for me, it actually went back to 2000. I'll tell you a little bit of that story I mentioned earlier, which was that I was in college during 2000. I started working on Wall Street in 2003. So I saw a small UTMA account that was in my name get cut by 70, 80% during the tech bubble unwind of 2000, 2001, 02. And similar to how you described it, I was like, well, why didn't, someone on Wall Street, why didn't some financial advisor give me a heads up? Like, how does this happen? How does this happen? And it really lit a fire under me trying to understand why we get the mechanics of markets, how things work. And so when 2022 came around, a lot of things kind of lined up and I'm like, whoa, this is it. This is what I've been waiting for 20 years. All these signals aligning. And I think that certainly influenced my perceived conviction. And we eventually, towards the middle end of 23, in the, let's say the beginning of the fourth quarter, I think we realized not only what we had gotten wrong, but where our blind spots were. And it really reshaped our process. And I think that's the good thing about the real value of being wrong in our business, which we're all wrong a whole bunch, is learning from it. It's such a valuable asset. The person who's right all the time, which I don't know if that exists, but that's where the black swans happen because you're overconfident. And so I think there was a little of that, but that certainly has helped us going forward. So our process constantly evolves. One of the things I love about what I do, what you do with Stephen, is that, I can't count on all my fingers and toes since the GFC, how many major macro shocks and narratives there's been that we all get to dive into and learn about as macro strategists, top-down investors, everything from the energy sector and break-evens. Now we're all experts on tariffs and constitutional law around tariffs, not something we know more about pandemics of the past. It's like every 6 months, a major macro issue has popped up that really is somewhat new and everyone kind of dives into it. It's in a way, when these things happen for the first time in a very long time, I think everyone is at the beginning of the same learning curve and we're not so sure how markets are going to react. And obviously, we're in the midst of one of those experiences today with the Trump administration and the volatility in communication around tariffs. So for us, I would say our experience in 22 and 23, I think in a way prepared us a little better, or certainly prepared us better for this type of market environment and even navigating March, April, and May. And if it wasn't for that experience and coming out of it with some learned and more expanded processes, and like you say, widening the distribution of potential outcomes, think about, well, what could go right? When everyone was talking about Deliberation Day, Black Monday, economic crash, and extrapolating the bad news, we were thinking about what could go right. The other side of the tail, because I think the one side of the tail was pretty obvious, where the other side of the tail, not a lot of people were thinking about. So that brings us, I guess, I'm curious if you can give us some current market thoughts. You don't have to give us the secret sauce, but curious to hear, given everything we just talked about, and today, we're recording this on Thursday. This will be out on Sunday. But today, the courts just shot down the majority of President Trump's reciprocal tariffs, and uncertainty remains. So I'm curious to see what your signals are telling you and what your outlook is for macro markets.
No, I appreciate that. Amazing. I appreciate you sharing those stories, man. That's a lot of people, and I'll answer your question, but a lot of that, just going back to your story, a lot of people, particularly in our industry, We're high performing individuals. We all went to the collection of schools that makes us feel very smart. And we've generally, most of us have had 45-degree angles, linear curves of success throughout most of our lives with little variance. And so for us, especially in the groups and communities that we're in, it's hard to say, I got this wrong. That was dumb. I need to learn. I need to know better. I don't know. Having these types of attestations and realizations, it's not easy. You're certainly in around a group that can be as arrogant as some folks on Wall Street, not everyone on Wall Street, but some folks on Wall Street. So I applaud you for making those process pivots as well. And it's funny that you and I had similar time periods, process pivots. We were both wrong for the right reasons, but for very different reasons. That was right after the market bottom, right after we authored our resilient U.S. economy theme. Our thesis then was the economy is going to be so resilient that it's going to hike way more than people realize. And they're going to drain way more liquidity than people realize. And it actually turned out to be true. But what I was missing at the time was China's impact on liquidity, Japan's impact on it, then the pivot out of the treasury. So I had to expand our research process to factor in liquidity in ways that I hadn't had to do before. It was very easy to understand where the markets are headed just based on the interplay between growth and inflation. Talk about the Dalio framework. His regime segmentation framework is a very popular framework that most people use if they're managing financial market risk from a top-down lens at this point. But it's not just about growth and inflation. This liquidity, the positioning cycle has become a beast in and of its own self, much more so than it was, let's say 10, 15, 20 years ago. And so it's all about learning and growing, figuring out what works, figuring out what doesn't work, and ultimately just being humble enough to stay on that learning journey as an investor. And so that takes me to answer your current question, which is how do we think about market risk? And ultimately, how do we think about helping clients position their portfolios? I'll give you 30,000 foot summary and then we can drill down from there. We are of the belief that President Trump was elected to transition the U.S. economy from paradigm A to paradigm B. And certainly that's what he campaigned on. Certainly that's what the red electoral college map from sea to shining sea indicated. And so in terms of explaining those paradigms, paradigm A is essentially President Biden's sort of K-shaped economy that was essentially propped up by excessive government spending, elements of monetary largesse, and so on and so forth in a way that created this very K-shaped distributional nature of the economy. The rich were getting richer from a household and business standpoint. The poor were getting poorer and getting stuck with inflation and or shut out of the credits. Paradigm B was essentially, hey, let's wring out all this excessive government spending, most of which does not go to poor people, by the way. I want to say government spends about $1 trillion, $1.5 trillion annually on poor people. The other 6 to 5.5, 6 trillion goes to not poor people. So you can assume that's part of the reason we had a K-shaped economy. And so wringing out the excessive government spending, putting up a tariff wall to re-incentivize domestic manufacturing capacity, and ultimately causing a narrowing of the disparity between labor share of national income and capital share of national. That, in my opinion, is what the people voted for. That would ultimately increase the supply base of the economy, lower inflation, reduce wealth and income inequality. And ultimately, this is the golden age of America that he promised. Obviously, if you're someone on Wall Street, if you're Wall Street in general, you might pretend like you like that, but it's not a good outcome for Wall Street. That is not a good outcome for Wall Street. You're talking about more narrow corporate profits. You're talking about smaller margins. So you have lower gross and operating margins and ultimately lower corporate profitability. Obviously, tariffs are a tax. And so they create friction in global trade. Globalization has been one of the great profit generators of all time from a macro catalyst perspective. And so reversing that obviously is not great for Wall Street either. There were so many elements of his agenda that were pro Main Street, con Wall Street. And even Secretary Bessent, who's pro Wall Street, even indicated some of that earlier this year. And so in our opinion, the path that they were on from, let's call it February to early April to April 8th, let's call it April 8th, was that path, trying to transition the economy from paradigm A to paradigm B. Ronald Reagan did it in his own respects back in the early 80s. And ultimately that process wound up with a multi-year bear market and a fairly deep recession. Now, in terms of our midterm turning inspired midterm election cycle, it's very unlikely that they're going to have the kind of political cover to really complete the full Ronald Reagan transition. And more importantly, Wall Street started fighting back, if only because of the nature in which President Trump tried to levy the tariffs, the reciprocal tariff. Obviously, that was a joke in terms of the Fisher Price formula and the trade on tariff off. It just became.
If you put Greek letters behind it, it makes it a little complicated.
I thought the same. It's like, are you kidding me with these Greek letters? Stop it. Oh my God. Yeah, I thought the same thing. So anyway, I think not only the destination that they were trying to achieve but the way in which they were trying to get there, both were problems for Wall Street, in my opinion. I would say the way in which they were trying to get there was equally as great or as much, or if not more of a problem for Wall Street. And so ultimately you started to see capital outflows from U.S. assets, sell America trade, which, I don't know if I've ever seen aside of the COVID crisis, 1 or 2 days in the COVID crisis, never in my career was the stock market down, the bond market down, the dollar down the same day. Yeah, I mean, we saw that multiple times. We saw the bond market blow up. We saw a real exodus of capital as foreign capital allocators, which the U.S. is the world's largest net international investment deficit economy by $26 trillion. We saw foreign capital allocators really start to question whether or not the U.S. was committed to the game that they orchestrated, the rule of law. They call it the rule of law, but again, global Wall Street's playing a monopoly game. Regular people are just pawns in the monopoly. And so what they saw was someone who got elected to knock over the board. And they're like, and says, we're not having this. And so ultimately, I think that stopped him dead in his tracks and forced him to pivot to a new paradigm, which is paradigm B. Or sorry, not paradigm B, paradigm C. So because I think they realized that, hey, going to paradigm B is going to be so hazardous and so catastrophic for both the economy and asset markets that we're certainly not going to have the amount of time it takes to complete the transition. We might as well just step on the gas. Let's just boom this thing and make the K bigger and hope that we get more trickle down from the top part of the K to the bottom part of the K. They're not going to sell it like that, but we know that's what's happening. We're talking about a copy and pasting of the fiscal largesse. And again, when I created this thesis over a month ago, probably 6 weeks ago now, it was not legislated that their House was going to copy and paste the fiscal largesse in the Biden administration, but now it's since been legislated by the House at least. They're copying and pasting the fiscal largesse from the Biden administration. They're going to, in our opinion, and we can talk about this ad nauseum later, not only copy and paste the monetary largesse in the Biden administration, but they're going to make it even more. They're going to give us even more monetary largesse. Plus, they're going to give us deregulation, plus some reshoring of industries deemed critical for national defense. When you add all those things up, those are all durable positive shocks to growth, in my opinion, durable positive shocks to the economy and profits and ultimately assets. Now, the media has been hyper-focused on the one negative thing, and that's tariffs. And of course, tariffs is a big change relative to paradigm A, and ultimately it's going to equate to hundreds of billions of dollars of lost economic output a year from a tax collection standpoint. But that's only one part of the stool. Bassett keeps calling it a three-legged stool. I don't know what to call it, but it's certainly not, as in my opinion, on a net basis, paradigm C is not a durable bearish catalyst for risk assets. It is a durable bearish catalyst for the dollar, and it's certainly a durable bearish catalyst for the bond market. But ultimately, we think over a medium to long-term time horizon, which is 3 to 12 plus months in our risk management nomenclature, we think the asset class, the capital flow story from asset class to asset class will favor stocks over bonds. It'll favor gold and Bitcoin over the US dollar. And ultimately, it may even favor international equities and credits over US. I'm not entirely sold on that last part yet, but I certainly am amenable to that view.
I'm curious because we've spoken a lot about the fiscal policy, and there's a lot of it between tariffs and tax bills and deregulation, immigration policy, Doge this year. I'm curious because I get asked this question and found it to be tricky and not always as relevant as it is today to incorporate some of these fiscal ideas, concepts, uncertainties into a framework, because it's not like that we have a time series of ongoing stable fiscal signals. These things come and go, and they come sometimes in big waves when we have recessions. And now we have a lot of them with not in a recession. So I'm curious how you think about or incorporate those into your framework.
Oh man, I'm sure. Great question, because it's made my job a lot harder. Fiscal policy is so damn messy from a research analyst standpoint.
Did it just make that distribution just wider and wider?
Totally. I mean, the amount you have to read to stay abreast of the game theory in Congress, the amount you have to read to stay abreast of the different levers that are going to impact the economy from the tax collection and expenditure standpoint. You're right. It's hard to do our kind of quantitative rate of change oriented time series analysis to fiscal policy. It's very difficult. And even then, the impacts of the changes in fiscal policy, their impacts upon the economy and asset markets can be dubious at best. Those relationships change and break down over time.
Absolutely.
So it's really hard. There is I don't want to say guesswork. Guesswork is certainly is disrespectful to the amount of work that folks like us have to do to get to these answers. But there is a lot of piecing the puzzle together in ways that we don't necessarily have to do when we're trying to forecast GDP or forecast inflation, or forecast the dynamics in the labor market, which, a little bit harder than those two. Our approach to it has been, one, you just have to, you're chugging a lot of material on a daily basis. It just is what it is. We try to analyze the fiscal policy dynamics from a line item perspective. So how is this thing changing? How is it likely to change? What's the change in the overall fiscal impulse? How it's likely to impact the economy? But again, there's so much of this stuff is projection based. So you have to rely on outside sources like the CBO, the Yale Budget Lab, or the committee. My favorite is the Committee for Responsible Federal Budget, because they share, for two reasons. One, they share my passion for fiscal consolidation at this very important moment to avoid what we see as a slow motion fiscal crisis evolving to a fast motion fiscal crisis, if only because of some of the forthcoming research that we perform. And also they're super bipartisan, tremendous amount of experience on the Hill. So you have to rely on all these outside sources and just try to piece the puzzle together. And the way in which we're piecing the puzzle together, as much as we talk, and again, I got dragged on Twitter last fall saying Doge is kabuki theater. It's going to be kabuki theater. They're trying to distract you from trillions of debt finance tax cuts. Now that Palapatia and Freeberg and all those guys, the All In podcast have said it, I guess I can get undragged. I won't get undragged. No one's going to give me credit for that, but I'm going to take the credit. Doge is what we thought it was, to borrow Coach Green's famous saying. Doge is what we thought it was. It's kabuki theater. And we have the trillions of debt finance tax cuts and only $175 billion in Doge savings. And we're not even sure if they're going to stick around in terms of rescissions. So there's a mask of fiscal austerity, but behind the mask is a very ugly gremlin called this one big beautiful bill that's going to add another close to $4 trillion of debt to the U.S. coffers at a time where we're having this geopolitically driven supply demand imbalance. Europe's remilitarizing, Japan's policy normalizing from a monetary standpoint, and China's strategically decoupling. Those are the three largest net international investment surplus creditors in the world, moving away or removing demand, incremental units of demand from the treasury market. At the same time, we're stepping on the gas in terms of treasury supply. So to me, I don't think it's going to end well. And ultimately, I think the Fed's going to be dragged kicking and screaming into solving the problem. U.S. commercial banks will be dragged before the Fed, kicking and screaming into solving the problem. They're going to relax the SLR, scrap it all together. And that's a form of financial oppression on top of Dodd-Frank, on top of Basel III, on top of Basel IV. So I think we know how this movie ends. But in the meantime, the number one thing I will stress to our clients and to investors worldwide is to take your dang nose off the tree that is tariffs, step back and look at the freaking forest. The freaking forest is paradigm C. These people want to grow their way out of the debt. They're not going to. Republicans have been promising that tired propaganda for decades. And I'm glad that I led the charge to wake the bond market up finally. The bond market realizes that we're not going to. But if this is their stated goal, you have to walk backwards from there. Walk backwards from there. And in my opinion, and I'll shut up because I've been talking, walking backwards from there, you have to assume that they're going to pull every lever they can to juice the economy, to deliver the wins that Donald Trump wants to deliver. This man wants to be popular. Don't get in his way.
Really interesting. Thanks for giving us your insights there. I want to touch on something because you mentioned how the industry has changed, how you have to look at a lot of things. You do work on and talk a lot about cryptocurrencies. We have a friendly environment for it now, it seems like, from a political standpoint. How did you get up to speed on that and start incorporating it? Because a lot of people did not. And then where you see the future of that?
Great question, Stephen. I'll be first to tell you, I don't know anything about cryptocurrencies. I'm a Bitcoin maximalist the day I die. I can't name 10 cryptocurrencies at all. And I have no interest in naming cryptocurrencies. They're just penny stocks to me. So in my opinion, I'll start by saying I have to give a shout out to a good friend of mine, Anthony Pompliano, and another friend of mine, Omar Sabak. They were the ones who introduced me to the power of Bitcoin, I would say a little over half a decade now, that really got me comfortable with investing in what at the time was certainly by Wall Street standards, a speculative asset class. And the more I did the research on what the fundamental drivers of the asset class were, and the more I did the research, the more I realized, oh my God, this connects perfectly to what I'm already doing. This is just another macro expression. Satoshi Nakamoto, or the group of engineers that are behind Satoshi Nakamoto, they created an asset that is the perfect release valve for everything that you and I are talking about today with respect to Paradigm C and everything we've been communicating to our clients for years with respect to our investing doing a fourth turning regime analysis in terms of how the fourth turnings have historically created these unique set of circumstances from an economic and fiscal and monetary policy perspective. That collection of circumstances is always wound up with more inflation, more debt, more monetary largesse, more fiscal largesse in ways in which that ultimately are designed to try to cure the populism or the demand for populism in an unequal K-shaped society. But ultimately, I think it all just makes it worse and worse until we wind up in some major conflict. Now, I'm not praying for major conflict, but I certainly think that we could potentially be on the route to one, especially if we don't find solutions to capitalize Treasury bond market over the long term. Not an acute risk, but certainly a long-term risk. So one of the things we did last fall was to change our systematic KISS portfolio construction process, which is a 3 ETF solution designed to help retail investors retire on time and comfortably. It's 60% stocks when it's maxed out, 30% gold when that exposure is maxed out, and 10% Bitcoin when it's maxed out. We were completely removed. So instead of the beauty of KISS was that when we first designed the system was, okay, we don't want standard 60-40 portfolio. We think adding 10% of Bitcoin in your portfolio in lieu of 10% bonds will create better outcomes for you long term. It's a hedge in case the bond exposure doesn't work out. We since last fall, go back to last October, we said, you know what, 30% bonds is highly incongruent with our fundamental research, things that we've been espousing for years in our investing returning regime research. Why not just bite the bullet, pull the plug, get this stuff out of my portfolio, because I use KISS to manage my entire worth, get it out of my portfolio and get it out of our client portfolios and just replace it with gold. And obviously it was a great call, but it wasn't a discretionary call. It was, hey, I need to make an amendment to this systematic process to account for the movie playing out exactly like I expected it to play out years ago. And so I think that was a very beneficial pivot that we made for our clients.
This has been awesome, Darius. I'm happy that after many years of us messaging back and forth on Twitter and crossing paths in the internet, that I got to finally meet you face to face and speak to you. I'd certainly love to have you on again as the story plays out. There's always going to be interesting things to talk about, and I'd love to speak about them with you in the future. So thanks so much for joining us.
Likewise, Michael and Stephen, man, you guys do excellent work as well. Any of our clients that are listening to this, to definitely check out their work. I'm a big fan of their work. I'm a big fan of anybody that only references a chart either visually or in their brain when they're talking. There's so much macro that is out there. And it's more so on the retail facing side of things, because you'll get laughed out of a room on Global Wall Street, just leaning back in a chair, talking about your macro views. Nobody gives a damn. Well, what's the data? What the data telling you? And so I hold you guys in high regard in that regard, because you guys are very much are data driven and understand the power and the impact of having these frameworks for which you absorb and react to data. Like I said, I don't think once you get beyond like a certain level of calculus and a certain level of statistics, there's really not much left in terms of being a good investor. The other half of it, if not more than half of it, is your ability to control your emotions and avoid these cognitive biases. And so our solution to that was to be systematic. I'm sure you guys have elements of systematic procedures in place in your risk management process as well. And so there's a natural kinship here amongst us. We're naturally going to be friends and have a good conversation. So I'd love to have this conversation again in the future.
Absolutely. Look forward to it.
Appreciate you guys. Thank you.
Thanks for listening to What's Next for Markets. You can follow Darius on X at 42macroDD and learn more about his research at 42macro.com.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.